Hey folks, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. Up on the screen, you can see mortgage-backed securities in the red, down 38 basis points. It's been a rough week, and the 10-year note ticking up to a very, very key level of 2%. So we're dealing with a couple of things. Obviously, the Russia-Ukraine story provides what they call as a safe haven bid into the U.S. dollar, as well as dollar-denominated assets like bonds and mortgage-backed securities and treasuries. But then on the other side, we have inflation, and we had the hottest print on headline CPI, 7.9% on a year-over-year basis in ever. It was just like something like 40 years. Forgive me. So really wicked hot inflation. But what the bond market is dealing with right now, and the number one reason why rate sheets are getting worse every day, is that inflation expectations, long term, 10-year inflation expectations, have ticked up sharply over the last week and a half. Everybody knows and sees what's happening at the pump with oil, but it goes beyond that. It's commodities, it's wheat, it's metals, it's everything exploding higher. And so those inflation expectations have crept up, and the bond market right now is trying to price in where inflation is going to reside. So it's very, very tough. Next week we have the Fed, and obviously they're only going to hike rates one time. Something that I think is important to share with clients is, in addition to the inflation expectations ticking up, and as the number one reason that why your rate sheet is getting worse, the Fed is going to hike next week, and that one is expected. What isn't expected, or I should say is expected but may not happen, is the future rate hikes. And here's why. Consumer sentiment is sitting at near recession levels, and that's before these historic prints on inflation. The last time the Fed hiked rates when consumer sentiment was this low was back in the early 70s, which ultimately led to a recession. They hiked rates again into the 80s when consumer sentiment was also at recession levels, and it ended up going into a recession. So we are going through a really tough time right now, and these are tough conversations to have with your clients. I encourage you to watch par on the 3% coupon for the Fannie, because if we break below that, as we're testing it right now here on a Thursday, and the 10-year note, you can see if that 2%, if it moves north of 2% materially, a couple days close, rates are probably going to move another leg higher. So not a lot of good stuff happening. It's probably also a good time to remind your clients that inflation, besides just being an economic killer, there's no safe haven. Stocks and bonds go lower in price when inflation's rising, and that's exactly what we're seeing. So I hope this finds you well. There will be better days ahead, but this was a tough week. Have a great day, and we'll talk to you soon. Bye for now.